Well, good morning, everybody, and thank you very much for joining us for what I'm sure is going to be a great conversation about technology and capital markets. For those of you who don't know me, my name's Rachel Evans, and I head up ETF coverage for Bloomberg News in New York. So the panel before dealt very eloquently with some of the big changes taking place in capital markets. We are largely going to stick within the fixed income realm and talk about how technology is changing the shape of capital markets there. Over the next 30 minutes, we're going to talk about the electronification of the bond market, how relatively new instruments like ETFs are helping with this, and how this is creating opportunities and challenges for traders. To do this, I am very fortunate to be joined by three panelists who have a wealth of experience on this topic, and I'm sure are familiar faces to many of you. From my far left, we have Billy Hult. Billy is president of Tradeweb Markets, which runs several debt-focused electronic marketplaces and recently went public. Billy, who's held this job since 2008 and also serves on the company's board of directors, is an expert in electronic fixed income trading, having led the development of several new marketplaces, including a platform for institutional trading in the to-be-announced mortgage securities market and a platform for wholesale electronic trading. Next to him, we have Jennifer Kim. Jennifer is co-head of ETF capital markets for the Americas at Invesco, where she builds and manages strong relationships with sell-side trading desks to facilitate transactions in the firm's ETFs. She also oversees the firm's ETF capital markets sales strategists and analysts and has been at the firm since 2015. Prior to that, she worked at PricewaterhouseCoopers and as an ETF trader on the American Stock Exchange. And to my left, we have Kevin McPartland. Kevin is the head of market structure and technology research at Greenwich Associates, where he focuses on how regulation and tech is impacting the fixed income, FX, and equity markets. Prior to joining the firm, Kevin worked at BlackRock as a director in the Electronic Trading and Market Structure Group and as a principal at Tab Group, where he founded and led the firm's fixed income research practice. Thank you guys all for being here. So I want to start off with the big picture, and then we'll get into a bit of conversation around some of the weeds of this. But Kevin, put this in a bit of context for us. What exactly do we mean by the electronification of the bond market?
It seems like it should be a simple question, but it's, I think, a bit more nuanced than that. Electronic trading tends to bring up in people's minds sort of a high-speed equity market, continuous trading, microsecond latency, high-speed traders. The bond market, first of all, is a much more diverse beast in and of itself, right? So government bonds, agency bonds, corporate bonds, all trade and have very different dynamics. And then the way that trading happens over the screen is also quite a bit different from market to market, from user to user, whether you're an investor or a market maker or a dealer. So if we sort of try to put that into numbers terms, corporate bond markets now have actually been on quite a run. I'm sure we'll talk about that a bit more. Now almost a third of investment-grade corporate bond trading is done electronically, which is up from about 20% at the beginning of the year. So it's been a tremendous year for corporate bonds. U.S. government bonds are one of the most liquid markets in the world. Almost two-thirds of that market trades electronically. That market's a little closer to how equities trade. And then sort of we go on down from there, sort of into mortgages and swaps and other derivative products. So, we'll talk about it a bit more, but, there's requests for quotes, there's streaming, there's a bit to it. But nevertheless, it is certainly growing and it will only grow more.
Yeah, so it's a broad term. Billy, I want to come to you because you've been in this business, pretty much since kind of the beginning of the electrification of the bond market. So how have you kind of seen this sort of changing? You've been on the coalface, as it were.
Yeah, so I'm just trying to think. So I joined Tradeweb in 2000. As you mentioned, I became president of the company in 2008. My roots were actually like in bond trading and bond brokering. So I kind of grew up in the business in the 90s. Where, I can say this like very obviously, like a lot has changed. Like I remember when people were like crammed next to each other, there were actually like people like smoking on the desks. There were, screaming and yelling and terminals being thrown. It was like a really different world. By the time I got into the kind of electronic world, there were the beginning parts of change. And I remember really distinctly. You guys can kind of laugh at this. I remember really distinctly going to visit, I think it was 2002, 2003, a big hedge fund in Connecticut. It was before there was the sort of big exodus from the banks into hedge funds, but it was really clear this hedge fund was like the smartest guys in the room. And they were not early adopters of electronic trading. And I remember going in and kind of like being in this conference room with them, and I got them to sort of admit that the pricing on the screen was valuable to them. And then I kind of made this like elaborate move where I kind of like took out their trading report and I said, let me go through your trading activity with you and show you how you've been using the platform. And so I kind of like went into my briefcase and I took out this piece of paper and like I showed them like a blank piece of paper. And they kind of looked at me and I was like, you guys don't use our system at all to trade. You're just staring at the screen. And I kind of got them to understand that if you don't start supporting the system through trade execution, the pricing that you find valuable will ultimately go away and become less valuable. And you know, over time, the first sort of movement, again, this is like this very specific client was like, okay, we're going to start using this. We get that. We're going to start using this for government bonds, liquid mortgages, small size trades. And I was like, okay, like we'll start there. And then a little bit later, it was like, okay, we're using this and it's working, but it's only going to be for markets that are like really quiet, really calm. Okay, so I was like, okay, so we're starting to head in the right direction. You know, ultimately, it's been through, I can say this very clearly, through innovations like we're doing, like Tradeweb's doing around AIX, where we're really making the clients more sophisticated in terms of how they find liquidity in the market. Where now we're seeing situations where obviously like trade sizes are like dramatically going up. Clients are now going into our marketplace when markets are at the most volatile. So we saw like amazing volumes, obviously like in October. And we're seeing this like massive change in sort of behavior in terms of how the clients engage with our marketplace. And so it's been this like amazing thing for me to kind of be a part of, because I remember that moment at that hedge fund in Connecticut all those years ago. And, you know, now they are, I can say this like, you know, very honestly, they're huge clients of Tradeweb, not just in rates, but in credit. And like that light bulb, it goes off and it's on. You know, and so that's where we are.
That's another amazing change, right? It's a few years ago when markets got volatile, e-trading would drop and phone trades would pick up. This year we're seeing it's reversed, right? People go to the screen because they can get better liquidity on the screen than they can get a broker on the phone.
We've had, you know, we're in all these businesses now, and you guys know this. I don't want to make it into a Tradeweb infomercial because this is going to be a really interesting conversation. We've had days where we do $1 trillion in volume. Okay, that's like this. Wow, that's like 1 trillion. You know, the truth is, and this is what's so super interesting, is it's basically, you know, the addressable market for the businesses that we are in are 6 times that. That gives you just a real scope of really how big fixed income is. And as much has changed in the marketplace since I described that way back when, there's all this room to grow, whether or not we're talking about credits or ETFs or other businesses that we're in.
Well, that's a great point, because I want to bring Jen in on the ETF point of this, because my understanding of kind of one of the sort of drivers of all this kind of electronic bond trading is that the ETF side has kind of helped to sort of bring the bond market into that sort of electronic world. Jen, how have you kind of seen sort of the uses of fixed income ETFs and the volumes that are traded in those ETFs kind of change over the last few years?
Yeah, so I definitely think we're all aware that the rise in fixed income ETF usage over the last few years, I think that's led to new use cases. You see different traditional credit clients now entering the fixed income ETF space, whether it be for a liquidity sleeve or transition management. You get people and new clients that weren't particularly ETF users in the first round, but now they're getting more and more comfortable. And as you see new users coming in, you know, people start to pay attention. And you've seen the sell side take more interest in how to make those markets easier to access, which has led to portfolio trading, rebalancing, and other areas to involve ETFs.
Yeah, I was going to say, so as the CDS market has largely dried up over the last 10 years, there's still some there, but it's not it's a shadow of its former self. So the credit market for a long time has been without an easy liquid hedging product, and it does feel, I think, surprising to even the creators of some of the ETFs, surprising how much ETFs have taken on that role, right? They are not a derivative, there's no leverage, but they still provide a very liquid hedge, or sort of, you know, if an asset manager has to park some cash while they search for the bonds, right, ETFs are really playing that role.
Jen, do you see that in particular Invesco ETFs that kind of stand in place of where CDX might have been used as a hedge?
Exactly. So depending on, so ETFs, we all know that they're comprised of their underlying holdings. So depending on what those holdings are, you can find an ETF that mimics cash, treasuries, something that is very liquid that you can get in and out of the same day if need to, for a day, 2 days, while you're trying to raise cash or hold on to another position.
It's almost hard on some level, and this is part of what we're talking about. It's almost hard to sort of overestimate how important I think portfolio trading and the evolution of portfolio trading will be into fixed income. Because if we think about it, there's just been a historical sort of dysfunction around how historically bid lists and offer lists have been circulated traditionally in credit, where the counterparties pick and choose which items on the list they want to respond to. And I think there's been an overall frustration in terms of the buy-side community around that behavior. Some of the evolution around all-to-all trading and open trading has attempted to solve for that liquidity. Our general view at Tradeweb is portfolio trading is almost like a 2.0 version of solving for that in terms of how we basket the trade and route it. I think that's like a really big, important development in terms of fixed income.
I would definitely agree with that. And I think in addition to ease of execution, so for example, trades that used to take hours, days, weeks to execute to get out of a complete portfolio where you're literally calling back and forth dealer by dealer, you can execute, you can do the research in 45 minutes and be done with the whole portfolio in 2 hours if need be. So I think from the buy side's perspective, the ease of execution is vastly improves. But then there's also the execution quality. So we've seen from our seat, the execution quality is also helping through portfolio trading.
So the other angle I would sort of taking on that ETFs portfolio trading, so as other markets like equities or FX really started to pick up from an electronic perspective, it was the entrance of sort of non-bank electronic market makers that really pushed the envelope and then forced the banks to get better. And it was a good virtuous cycle. I think ETFs have actually played a big part in bringing those participants into the credit market, right? Because the market turnover was so low before, there were no hedging products as we just spoke about, so there was no way for them to come in. It didn't suit their style. But now that they have that sort of ETF hedge or ARB as a natural trade, they can make markets without deploying a tremendous amount of capital.
Yeah, I think that's 100% correct, Kevin. And then I would also say sort of like the Treasury actives market brought in the PTFs originally, right? And so like way back when, if someone had said, that the PTF markets would be the 5 biggest PTF firms would equal XYZ, some big percentage of the Treasury actives market, I think people would be surprised. But they've made this obviously like huge mark in terms of how the Treasury actives market trades, and now you're seeing their behavior really kind of become really important around ETFs. So it's an interesting evolution for those firms.
Just to interject, on portfolio trading, in terms of kind of like what we mean by that, we're talking about kind of large kind of baskets of bonds being exchanged in one kind of trade, having a price for that entire basket. And the ETF kind of sort of steps in to act as sort of an inventory management sort of type tool, but also, to Kevin's point, as a hedge. We're kind of seeing that sort of becoming more and more of a part in the fixed income market.
Yeah, and one way to sort of oversimplify why portfolio trading is a good thing for everybody, really. If you're an investor and you have that basket, and there's, I don't know, there's 25 bonds in it. If you were to trade them each individually, maybe you'd get good prices on some. You'd probably get not so good prices on the others. That would lead you maybe to not trade them. If you trade it as a basket, the couple of good prices maybe get sort of adjusted for by the good prices, and then when it's looked at as a single trade, all those orders get executed because it does work in the end, whereas if they were single trades, they probably wouldn't have happened.
In some ways, what we're kind of talking about a little bit is like sort of like how markets continue to innovate even once they've begun to go electronic. And I think that's like a really important sort of theme, which is like the market shows signs of really having the benefits of transparency and electronification and ease of use and all of these things. And then they wind up sort of innovating past all of that. And I think, for example, in credit, portfolio trading is an obvious example of continued innovation in this big, important marketplace. There are obviously other ones, but I'm always very well aware of the fact that just because a market goes electronic doesn't mean that the innovation stops. In fact, the most important pieces of innovation sort of begin at that point.
Yeah, I mean, I would agree, right? The more electronic trading we've seen, the more data that gets generated, which can then be injected into the pricing and the investment algorithms, which then leads to more trading, and on we go. And we've reached a point over the last, really, it's probably been the last 5 years where the technology available to even process that data, structured or unstructured, and then do something with those results has just really accelerated. It's really amazing.
And I want to come to the data aspect in a moment, but before we kind of go there, I'm just kind of curious as to sort of how the electronification of bond market, ETFs kind of becoming more of a part of the fixed income market, portfolio trading ticking up, how that's actually changing the shape of the desks. Like Jen, you work with a ton of banks to kind of sort of transact ETFs, make sure that your ETFs are trading smoothly. Like, do you see kind of the changes in who you're speaking to on the other end of the phone or via instant message?
Definitely. I think with regards to executing in the fixed income space, so whether it be portfolio trading or just ETF bond trading in general, I think, as Kevin alluded to, you used to see more of the electronic market makers really doing portfolio trading without knowing it was a portfolio trade. So they were executing large baskets of underlying bonds to help a fixed income ETF rebalance their portfolio or even deploy cash. Now we're seeing that expand to maybe the traditional bulge bracket banks that are getting involved and kind of seeing the opportunity in that space. So that could be, the larger global banks kind of reorging their teams around portfolio trading units. And because it does require a lot of coordination across desks, I think as we've all said, it's taking a portfolio or a basket of bonds that maybe one trader is not trading, and you have to aggregate that basket to price it out. So if you don't have the coordination across the desk, it's not going to work. We definitely see a lot of reorg there.
Fixed income is, as everyone here knows, still a pretty quirky marketplace, and so we're a long way from when I was kind of joking about people throwing computer terminals at each other. Relationships in the space still matter, and it's just an evolution, really. And so we've seen a lot of, obviously, different types of skill sets sort of emerge over the last few years. So absolutely, everyone's become sort of more quantitative. Everyone has to bring in a certain technology kind of lens into how they engage with fixed income. But I think at a very basic level, the relationship aspect of the business is still there and still meaningful.
Yeah, I would agree with that. I mean, maybe they just send angry emojis at each other now instead. No, so one of my favorite findings from our research over the last year was we did a study talking to about 50 fixed income dealers on the desk. We asked them a whole host of questions, but we asked, when you're hiring, what are the skills you're looking for? So number one was relationship management, which, as you say, people certainly still matter. But number two, for the first time, with data management, which we thought, we just had a bunch of bond traders tell us that they're hiring for people that understand data, which I feel really exemplifies how much the market has changed and what that was the sell side, but really what every market participant is expected to be able to do and how you can be successful on a day-to-day basis.
Mm-hmm. That's a great point. And I think this is kind of the other sort of side of this electronification of the bond market, is just how important data and transparency and that information is becoming. Kevin, perhaps you could elaborate on that a little bit, just in terms of kind of what's been changing. Are we talking about more information? Are we talking about different ways that information is accessible? How does that kind of whole data world look that clearly banks are trying to hire for?
Yes to both of those questions. I think so. If I think back, I think one of the big changes that really helped to catalyze was 5 or 6 years ago now, when sort of continuous evaluated corporate bond prices started to hit the marketplace, right? Whereas instead of a trader having to sort of run bond math on an Excel spreadsheet to figure out where the bond should be priced, now we were taking the, say, 30,000 CUSIPs in sort of corporate bonds and continuously provide evaluated pricing. And at first people thought, oh, that's interesting, but we can't trade on that, so it's not that useful. But as more and more artificial intelligence and then obviously more data has been injected into that process, and now there's competition, there's several providers, those prices are getting better and better and better. And it's really, I think, changed the dynamic.
That's 100% correct. And I would say, in an interesting way, as much as we talk about data and the sort of obvious benefits and how we're all getting smarter and more sophisticated in terms of how we create these different pricing models and doing all this stuff, we have smarter people working at Tradeweb than we've ever had before. That's such a huge emphasis for us. There's this balance that needs to happen, I think, around the integrity of a trading network and a trading platform, and the sort of data of it all can't create an imbalance in terms of the ecosystem. And that's a really important, I think, concept that sometimes doesn't get enough airplay as we talk about all this obvious benefits of data. You have to get that balance between the benefits around the market participants really right.
The municipal bond market, I feel like, is another really fascinating use case for data and sort of innovation. It's I think they might still be throwing computer monitors, from what I understand, in the muni market. But now, we're at a point where about 15% of that volume is traded electronically. But we have to remember there's 1 million tradable securities at any given time in the muni market, 1 million, right? And the market is regional, obviously, by definition. But now, so some of these, I think the most notable ones are some of these electronic market makers are quoting continuous prices in over 100,000 muni bonds at any given time. I mean, that's amazing.
Yeah.
So, Jen, how do you guys think about that at Invesco? You've got all of this information out there. You're not just looking at the muni market or credit. You're looking at munis, credit. You're looking at loans. How do you find the information that's actually going to be helpful to you and make sure that you have processes and technology in place to use that rather than kind of getting bogged down in all the noise that's out there as well?
Definitely. So so our traders, as there's more data and more trades in the fixed income space that are actually being executed and reported, there's more pricing transparency. So that allows us to have more accuracy when we're going in to put these portfolio trades, which, 2 years ago they didn't really exist. A year ago there was maybe doing 40%. Now we're up to almost 90 billion in portfolio trades this year, and we have more trades to actually price that out to know, are we getting good levels? So we're looking at that from a trade execution, so making sure that whether it be for a portfolio rebalance on our ETF side or on our active side, or new money coming into any of these funds that we need to deploy these types of strategies, the more trade and traceability and transparency we have into pricing and data, it always helps our PMs make sure that they're making the right decisions on behalf of our shareholders and clients.
And Billy, I mean, in terms of kind of like that whole data and execution aspect, I mean, how does this kind of like help you guys in terms of that volume you were talking about, 1 trillion? You can't be sort of like going through every single trader and pricing that, or transacting that. So how do you kind of think about sort of tech and data and helping with that volume?
Part of the story around kind of how you get to these kind of volume levels and how you get to this sort of transparency in these marketplaces has to be the story around the evolution of kind of AIX, which is something that we talked about a little bit before.
For the audience, AIX.
Yeah, it's essentially an algorithm that allows the clients to engage in a much more sophisticated way with the banks in terms of who their counterparties are, in terms of what kind of trades they should send out to the market at a given point in time. When I told you guys that first story, it was really a story about how do I get somebody and how does the company get someone to wind up clicking on a mouse and doing an electronic trade that way. This next evolution of the marketplace is all about kind of moving from, the mouse to the algorithms that allow clients to find their counterparties. So the mouse, in a very basic way, ironically, is obviously starting to kind of go away. It's gone from, the kind of expression is we're kind of going from kind of low touch to no touch. And I think, you can't get to these kinds of volumes without that version of innovation that clearly is a big part of the marketplace.
Yeah, absolutely. And if you think about sort of an average sort of sell-side corporate bond desk, they're getting 10,000 or more inquiries on any given day. It's impossible, absolutely impossible to do that without technology to auto-respond. You just can't.
Yeah, I think you would have a great sort of perspective on this. I think there was a point in time where there was a pretty decent disconnect between the level of sophistication with the banks and the buy side. And I feel like the buy side has become much more sophisticated, specifically over the last couple of years in terms of how they engage.
Definitely. I think points of connectivity, as asset managers are touch points at different parts of the firm. So whether it be on the active side, the ETF side, there's more collaboration. We're going off to our counterparties in a more uniform way. And I think, technology has definitely allowed us to do that.
Yeah, I mean, I think for the probably for the history of Wall Street, it's always been assumed that the sell side, the broker-dealers, have the information advantage over everybody else. We had been hearing sort of casually that really wasn't the case anymore, that it had shifted to the buy side. So as we do...
Still more powerful now.
Yeah, well, I mean, as we do, as a research company, we said, oh, let's go ask them. So we asked the buy side, who has the information advantage? And absolutely more of the buy side responded and said, we have the information advantage now than
Well, and
otherwise.
if you assume that, we're the client ultimately, and we, they want to give us their information, they want to sell to us, they want us to be their client. So as the buy side, we're looking for counterparties, and we're consuming all of that data that each of our counterparties is giving out, and vendors and others. So it gives us the opportunity to build those proprietary systems to house that data, to see then where can we execute. What else is that data showing, whether it be trends in the market, client movement, inventories. It just opens up a different avenue for the buy side.
Billy?
I know I have so many different types of clients in my business. It's amazing. And to see the way that they've kind of evolved and developed into the marketplace is really like, this is a moment where the conversations we're having around portfolio trading, around AIX, evolutions in credit trading, we haven't talked like this about these topics before. And I'm really, really excited around kind of where this is going, because it's clear that this is a moment in time in terms of the balance between the banks and their clients, where there's going to be a lot of evolution over the next couple of years. The role data plays around all of this stuff, and the balance, the need to get that right, I think has never been higher.
I mean, we've been talking really all about institutional interactions, but in the end, this is why we all can trade or have access to ETFs, mutual funds, whatever the vehicle is, right, to get access to the bond market for almost nothing at this point. It's really amazing. And I think all of this innovation is why we're at this point.
Yeah, if someone had told me on my ride back from that hedge fund way back when that Tradeweb would have gone public and I would have been back in this building a bunch of months later, feeling very proud about what the company had accomplished, and we'd be talking about all of this stuff, I probably would have been fairly both happy and probably surprised.
Yeah.
Well, that's a great point, because we are seeing this kind of sort of seismic shift in the market, and there's a lot of kind of speculation about what that kind of means for sort of the entrenched players and their bottom lines. And I guess I'm kind of thinking there about sort of that shift from sort of the traditional banking relationships to this kind of more electronic sort of way of doing business. Like, who are the winners and losers here, and is it just really bad for those that don't adapt to this new world?
Yeah, I mean, you have to adapt, right? And I think it is, relationships still matter a lot. People are still people. Even if you are interfacing with an algorithm provided to you by a broker, you still need to trust who's coding the algo or who's selling you the algo to believe that you're getting what you say you're getting. So I think trust really matters. And I think we've seen, now it's been a decade really on since the catalyst for most of this change. And I think we've seen most of the bigger players adapt, and obviously there have been some that haven't adapted fast enough, and that hasn't worked out so well. But there's been some notable, sort of earnings reports from some of the big banks, the ones who have really doubled down on technology, that have managed to reshift their business model and maintain their share and sort of evolve.
And Jen, is the same true, do you think, of kind of the asset management world and the ETF issuers out there?
Yeah, and I think that as the client, again, as we're kind of consuming this data and building up our infrastructure and technology to support the data, and more data is valuable, I think we're pushing the sell side to adapt and to kind of transition, and where we see, the winners and the more successful platforms, we're pushing others to kind of keep up with that and keep innovating. Because I think in the end of the day, it really only helps the investors, the clients, the fund holders, because they're getting, again, more transparency, better execution, better ease of execution, which ultimately comes down, tightens bid-ask spreads and what you're actually paying to get into or out of a fund or a bond, whether you're an ETF holder, a mutual fund holder, or a single bond holder. You're going to see more transparency and better execution.
And we're running out of time, but Billy, I wanted to come to you just because you had a really great point on this, and in terms of actually a moment of hope, I guess, for the banks. Maybe it's not quite as bad as.
Well, yeah, I mean, it's interesting. We're kind of talking about like who the winners and losers might be, but I think as important is just the general concept that there will be winners. But this is a moment in time where there will be winners, and I think that in and of itself, I think, is 100% worth stating.
Yeah, I mean, a shout out to Tradeweb and some of the other bond venues, right? If you look at the market capitalizations of these firms, they're as big as some of the global exchanges that we would have sort of thought about years ago. It's amazing transformation.
So there you go. You kind of got to be paying attention to this because it's really changing the structure of the capital markets that we all work in. I'm afraid that's all we've got time for. So thank you guys so much for taking the time. Please join me in a round of applause.
Thank you. Great job.